course, just like now, the politicians and policymakers were declaring victory. We whipped inflation. What it turned out to be is an early victory lap that was unwarranted because inflation came back with a vengeance and even came back worse. When Bush took office, it was at a very lofty level, roughly where we are today in the mid to high 30s. Predictably, as this valuation suggested that stocks would return not so fantastically over the Bush era. And in fact, that's what we saw. Hello, everybody. This is John Llodra. I'm a co-founder and partner here at New Harbor Financial Group. Thanks so much for joining me here for this weekly video. Through these videos, we try to bring data, our insight on that data, all for the purpose of educating and empowering our clients and our viewers to make sense out of what otherwise can be a very confusing financial world. We don't like to dive into politics in these videos, mostly because sometimes the politics and kind of the political promises that get thrown about, especially during an election, really are nothing more than hype and headlines. And as things play out, the markets kind of sort things out. But there oftentimes is a fair amount of volatility and kind of movement in markets leading up to and immediately after elections. In this video, I'll cut through the noise. I really want to provide some clarity and bring it back to some of the fundamentals and some of the takeaways that one should focus on. I plan to highlight 4 key factors, you might even call them wild cards, that I think can really affect the outcome of the next 4 years, more so than some of the headlines and some of the campaign promises. These wild cards, you might say, quote unquote, could trump everything else. So stick around because I'll talk about some of the areas that we think could outperform in the times ahead. Some might be surprises based upon what we've observed from history. So it's been 2 weeks since the election. There's been some pretty sharp moves. We saw a very sharp move higher in the stock market immediately after the election. Now, about 50% of that bounce has already been repealed back. So markets have been weak in the last handful of days. So the initial knee-jerk higher in the stock market has, again, about 50% of that, as of this recording, has been given back, just as evidence that perhaps the markets are settling down and getting back to, quote unquote, the business of making sense of the world, not based upon headlines and buzz, but on fundamentals and reality. Turns out, with the election results of a couple weeks ago, we're going to have a sweep in the Republican Party for the executive and legislative branches. So let's go back and look at history and see what that has meant on average anyways for the markets. So this graphic looks at the average annual performance of the S&P 500 going from 1933 to 2022. Now it excludes a brief period here from 01 to 02 because, as you can see here, there was a changing of parties. Generally, markets on average have performed best when there is a divided Congress, almost independent of what party is in the presidency. Roughly equal, 13.6 versus 13.7% average performance. Now, there's many theories as to why a divided Congress maybe has been the best environment for markets. And that's one very leading and I think compelling theory, is that markets like to have some discipline. They don't want politicians to run away with the store, so to speak, and make all kinds of promises and make short-term decisions that have damaging effects long-term to the economy and markets. If you look under the scenario where Republican president and Republican-controlled Congress, it's not too far behind. It's 12.9%. So that's the scenario we have. And we have a saying here at New Harbor that an analysis of averages leads to average analysis. Is because, of course, there are all kinds of nuances that will dictate what happens in any given presidential term. So you lose a lot of context when you take averages over those broad period of time. So now I would like to turn at this point in the video to 4 key factors that could literally, quote unquote, trump everything. These are wild cards that I think really set the backdrop here, even more so than some of these policy platforms and kind of promises that were made during the campaign. So the first wild card that I want to talk about is valuations of the stock market. This table here was put together by Goldman Sachs Investment Research, and it shows since 1976 how extreme we are in various valuation metrics. It measures the percentile. So for example, you can look at these various different fundamental metrics. For example, forward price to earnings ratios, price to book, enterprise value over sales. Almost every one of these for the aggregate index is in very, very extreme territory. You don't get more extreme than 100%. That means there were 0% of the time since 1976 where this valuation metrics was lower than it is now. 99%, super, super extreme. And that also applies to the median stock. So this is not just large cap stocks are swaying valuations to the extreme side, but even the average stock, we have very extreme valuations. These valuation metrics ring true with a whole bunch of others. For example, the work of firms like Grantham, Mayo, Van Otterloo speaks to very extreme valuations here in the US anyways. And there's plenty of quotes out there from investing legends that say ultimately what matters over the long term is the price you pay for something. Valuations are very terrible short-term indicators. They don't say really anything about what happens in the short term because frankly, even in bubbles can expand to even further lofty valuations than they already are. But they are very good predictors, historically anyways, of what might happen, say, over the next 10 years, 5 to 10 years. But broadly speaking, the U.S. large cap stock indices like the S&P 500 are very, very overvalued. And that likely portends to disappointing returns, irrespective of economic policies of the current president. One example of that is the presidency of George W. Bush. He was elected in 2000 and served for 2 consecutive terms there. Many of the policies, now, of course, there were vast differences between Bush and Trump, were exactly the same, but there were similarities. For example, the reduction of taxes, the relaxation of regulation. And it was also a period where it was a Republican-controlled executive and congressional branch, just like we have now with Trump. So there are enough similarities there to say, hey, wouldn't it be interesting to look at that? If you look at where valuations were when Bush took office, this is a measure called the cyclically adjusted PE ratio. One of the most robust metrics we can look at in correlations with statistical returns. When Bush took office, it was at a very lofty level, roughly where we are today in the mid to high 30s. Predictably, as the valuation suggested that stocks would return not so fantastically over the Bush era. And in fact, that's what we saw. If you actually look at what happened in the Bush administration, you had the S&P 500 for the first term and second term lose value. In fact, so over the whole presidency, the S&P 500 lost value on a total return basis. The NASDAQ, the tech-heavy NASDAQ, lost even more. That was because the tech bubble was right on Bush's doorstep when he entered office, and it was in the process of starting to implode, and implode it did. Interestingly, however, even though the areas that had lofty valuations did very poorly, other areas didn't do so bad. In fact, things like emerging markets and commodities and small cap and mid-cap stocks and even developed foreign stocks did much better. So just because we have valuations that may portend very disappointing returns, irrespective of economic policies, doesn't mean there are no places to find good returns. And we can see this even if we look further on a sector level. So things like gold and energy and materials did very well, commodities, whereas financials and technologies and industrials and things like that didn't do so well in the Bush administrations of the 2000s. But the key takeaway there is valuations, as lofty as they are right now, are likely to be a big wild card that will trump most everything that will come out of the economic policies over the next 4 years. But as I just alluded through these charts, there will likely be areas that will do well in the coming 4 years. Stick around because I'm going to touch upon our view on some of those later on in this video. So let's move on to the second key factor or wild card that could really affect how markets unfold over the next 4 years. And that specifically is our vast and growing budget deficits. One of the things that most people agree, even on both sides of the aisle, is that our spending as a government has gotten out of control. We are spending way beyond our means, been exacerbated by stimulus programs in the wake of the great financial crisis and in response to COVID, but at levels that are, by everybody's estimation and admission, unsustainable. Everybody from the Federal Reserve to foreign entities, foreign central banks are concerned about the budget situation here in the US. This chart paints a pretty sobering picture in that regard. This goes back and looks at the budget deficit as a percent of GDP under each president since 1900. And you can see here Trump's first term and then Biden's term. And this is, I think, through about July of 2024. But you can see off the charts, both Trump and Biden, relative to more recent history, has been off the charts in terms of budget deficit spending. The only time that really rivaled that was in the lead up in World War II. It's pretty dramatic stuff and very concerning to any citizen or taxpayer, in my opinion. And the future does not look any better under current scenarios. This is a projection that was put together by the Government Accountability Offices, which is a nonpartisan agency that was empowered by Congress to look at these things. And it basically shows a rampant, steady rise in the percentage of GDP that is our debt load. You can see under these projections, it has us going healthily above 200% of debt to GDP. These are the kinds of numbers you see in kind of banana republics, frankly. And yes, we have the reserve currency here in the US, but that is increasingly becoming something that we shouldn't be so arrogant to think we can rely on. Get another look at this. This shows program spending by the government in the dark blue bars, and then increasingly interest spending, interest on our debts. That's becoming a bigger and bigger issue, especially as interest rates have risen. And you can see our revenue is primarily taxes, the red line. There is a primary deficit here and then a total budget deficit that balloons out into the future. That's projected and not at all a good picture. Now, as we know, Trump has established a entity called the Department of Governmental Efficiency, going to be headed by Elon Musk and Vivek Ramaswamy. And in the lead up to the election, there were kind of claims that, hey, we think we can save maybe $2 trillion a year from government spending. That sounds awesome if we can do that, and truly. And we all know, I think anybody that has paid attention, whether you're on one side of the aisle or another or an independent, knows that there's a vast amount of waste in government spending. And who doesn't want that to be snipped out of the budget? But the question is, can we really achieve targets of, like, say, $2 trillion? This is a breakdown of where our government spends money. And you can see some big ticket items. The biggest one, of course, though, is Social Security, and this is in billions. That's 1.3 trillion in Social Security payments. You got health, you got Medicare, all these things here. Even national defense, we know that's a big budget item, but it pales in comparison to things like Medicare and Social Security. Of note, the interest expense is becoming a bigger line item here, and that's a problem. So if you just do the math here to ask where could we get $2 trillion in savings, I would challenge that even though there are plenty of fat in the budget that could be cut, I think that $2 trillion is likely to be very aspirational, if not impossible. So something to think about. And of course, that has implications in terms of our budget deficit. If we can't cut spending and we want to keep taxes low, something just doesn't add up there. And so some of the promises may be more difficult to implement than the taglines or the buzzwords in the election would otherwise suggest. Now I'd like to go to the third key wild card or factor that could dictate what happens over the next 4 years in markets. And that is the potential for inflation and further increases in interest rates. As many viewers know all too well, the cost of living saw a pretty massive spike over the last handful of years. And yes, it's been celebrated in newspapers and on the news, and certainly by politicians and policymakers alike, that there has been a dramatic reduction in the year-over-year increase of inflation. What that doesn't tell the truth about is that our costs have still risen and many people still feel it in their pocketbooks. Big wild card there is if we return to a inflationary episode like we did in the 1970s. This chart here shows the inflation in the 1970s, which is the blue line, and that's measured on this right-hand scale. You can see in the early 70s we had a run-up inflation in this blue line, and then it pulled back. And of course, just like now, the politicians and policymakers were declaring victory. We whipped inflation. What it turned out to be is an early victory lap that was unwarranted because inflation came back with a vengeance and even came back worse. It was by 1980 going at about 13+% a year. The red line here shows the period here starting in 2017 overlaid. So you can see the run up in inflation here. This was in the 21-22 period. And then yes, the last couple of years we've seen year-over-year inflation come off. Still not at the 2% target that the Fed has kind of pronounced as the holy grail of inflation. But the big fear is that we could see a rise back up here in inflation, which is everybody would agree is not a good thing. And it certainly could have negative impacts on things like interest rates, our ability to borrow both as individuals, corporations, and as a government. The interest rate on U.S. government debt has already spiked pretty dramatically in recent years. And I thought it would be helpful to take a glance at what the inflationary episode of the 70s actually meant for markets. You can see here, this is asset class returns during the 1970s. And let's start with the most basic types of assets that most everybody focuses on, stocks and bonds. The S&P 500 lost money on a real return, inflation-adjusted return basis during the 1970s. So did Treasury bonds. Things that did well were commodities, things like gold and oil and silver and wheat. Real things, tangible things that long-term can be a good hedge against inflation. So the fourth wild card I want to talk about that could really impact markets over the next 4 years are trade or currency wars. Again, Trump has talked a lot about posing tariffs and doing all kinds of protectionist type of policies, all in the spirit of benefiting U.S. companies and manufacturers. It's a tricky environment. We're a global market, deeply global supply chains, as we saw all too well during the COVID disruption. And even the ideal of kind of bringing things more onshore here to the U.S., we're talking about decades of that being offshored. And to think that we could do it overnight would be quite naive. So this first chart shows the level of tariffs, U.S. weighted average tariff rate on total imports. When Trump was in office for his first term, this is what it looked like. The bump up in tariffs was noticeable, but not dramatic. If Trump imposed tariffs of the full amount that he talked about during elections, we'd see a spike higher on the average tariff rate on total imports. That would have made the Smoot-Hawley tariff of 1930 look like child's play. And of course, many academics and historians point to this tariff act as being one of the main factors that at least started the Great Depression. In fact, I think Trump, he's a master negotiator in some respects. He's got a book called The Art of the Deal. And I think much of the talk about trade tariffs really about a bargaining position. I think it would be naive to think that the full weight of tariffs that were talked about during the election were actually implemented. And in fact, if we go back and look at Trump's trade policies and tariffs in his first term, we can see that the actual market impact was rather negligible. And you can see all these different trade war escalations that happened in 2018 and 2019. And you can see the percentage one day and 1 week change in response to these moves was rather insignificant. This chart here is in the same paper, and it was looking at the IMF World Economic Outlook, a study they did. And it basically looked at a trade war scenario where 10% across the board tariffs were implemented and full-scale retaliation by all countries. And you can see here the base case and the trade war. The difference in GDP impact is noticeable, but not dramatic. The bottom line is I do think, and markets could see a economic contraction as a result of tighter trade policies and tariffs. Even though the numbers look like they're not that dramatic, a little bit on the margin there could affect corporate profitability quite dramatically. And we're already in an environment where valuations are sky high, as I've already talked about. And any bit of contraction and growth can really cut earnings estimates and margins that would make these stocks look even more expensive. I want to kind of point out that oftentimes what seems like a sure thing oftentimes is not. This shows for the various sectors of the market and the S&P 500 itself, the total year returns, maximum, minimum, and average returns going back to 1990 through 2023. In every instance, whether you're talking about the market or a sector, it didn't matter that you had a Republican or Democrat. There were plenty of very, very negative worst case scenarios. In other words, even the broad market from seeing hugely negative years. And then some other surprising things come out. You see, for example, many people think that traditional energy, oil and natural gas, are destined to do phenomenally well during a Republican administration and phenomenally bad during a Democratic administration. Yet, in fact, you can see that on average, oil and energy has done better and has had some of its best years under a Democratic administration. In fact, if you look at, for example, comparing traditional energy, oil, natural gas, with renewable energy, during Trump's first term, renewable energy did phenomenally well, and traditional energy did much worse. Completely the opposite during Biden's administration. Renewable energy during Biden's current administration has done horribly from an investment return standpoint, yet traditional energy has done very well. So let's talk about areas that we think can do quite well. And again, this is just our outlook. Will change as markets change. We talk about deregulation. So first of all, we have little doubt that Trump will try to cut back on regulations. The sectors that probably most impacts the most are financials and industrials and energy. So those are three sectors that we think could do quite well with that tailwind. If we talk about trade wars or restrictions of trade and protectionism, in a simplistic way, we think that will benefit domestic producers, companies that have local supply chains or at least not very heavily reliant upon overseas supply chains. And it will likely not do so well for companies with large export markets, especially if the dollar rises under that scenario. So even some of our large mega cap tech companies, the Apples, those kinds of companies could be at risk in terms of their projections in a trade war type of scenario. And then we think there are all kinds of areas of the markets that have much more compelling valuations than, for example, the S&P 500. This includes emerging market stocks. It includes energy and natural resource stocks. It includes value stocks as compared to growth stocks. Much of the last several years, growth stocks have been the only show in town, and value stocks have been kind of a trap, if you will. Similarly, what we might call high quality stocks. These are stocks that either have shareholder-friendly dividend policies or they have very conservative balance sheets, they pay down debt. Quality stocks we think will do well even in a broader bear market on a relative basis anyways. And that's not been the case for many years. In fact, some of the most speculative stocks have been the ones that have performed the best. We believe that small and mid cap stocks will likely outperform both on the up and the downside relative to large caps. And then I'd be remiss if we didn't talk about the importance here of, we think precious metals and monetary and inflation hedges are likely to be very, very important. Can be too much of a good thing, and we're not suggesting you have 50% of your portfolio in these types of things, but we oftentimes will say 5 to 10% in precious metals is a very prudent diversifier and hedge against some of these factors. It's important to have a system to identify these trends as they emerge and not try to anticipate them. Our approach here at New Harbor, we use tools like relative strength and other analytical-based mechanisms to try to control our emotions and not try to chase hype, but what the market is telling us at any given point in time. I want to conclude this video. Now we have the election behind us. Many people have told us, clients and prospective clients, that they were concerned about the election. They wanted to wait until things settled down to kind of refocus and think about their portfolios, and especially as it relates to their lives. Now that we've got that behind us, is a perfect time to start to re-examine how you're positioned, and most importantly, again, how your portfolio positioning serves you and your life, your specific timeline, your specific goals, and we'd be happy to have a very personalized conversation with you about that. Until next time, I want to thank you again for tuning in here. Invite you to subscribe, comment, reach out to us. We really appreciate the interaction, and I want to wish you a great day. Thank you.